Hi guys, today I'm going to introduce to you chapter 7 in our book, which is cost volume profit analysis. Cost volume profit analysis, we are going to learn how cost volume affects profit. Volume and costs are the only elements that can change or affect volume. What do we mean by cost? By cost, we mean two types of costs, fixed and variables. So these are the costs that we'll be talking about, the variable and the fixed. While by volume, we simply means the number of units produced, because we believe what we produce is what we sell. So in order for you to make profit, you have to make sure that you make use of these two elements, the cost and your volume. Then CPV analysis is a cost accounting model used to analyze and interpret how change in selling price, variable costs, volume, and fixed costs will affect profit. You need the higher profit or the lower profit is going to be influenced by these variables: selling price, variable cost, volume, and fixed, which means we have in total 4 variables. Selling price is number 1. The higher the selling price or the lower the selling price, it's going to change your profit. The lower your variable cost or the higher your variable cost, they're going to increase or decrease your profit. Number 3, volume. The lower the volume, the higher the volume is going to affect your profit. Or any change in your fixed cost will have a negative or a positive uh, impact on your profit. So this is the main focus of chapter 7 in our book. We must be able to learn how to calculate contribution margin per unit, percentage, or in total. That's requirement number 1. Requirement number 2, calculate break-even point either in units or revenue. Number 3, margin of safety either in units, percentage, or revenue. Number 4, the number of units to achieve target profit. Number 5, you must learn how to prepare your marginal income statement. Then the last part of the chapter will all be about sensitivity analysis, which means we will be using everything we have done up until here to prepare an income statement. Should there be an increase in selling price, a change in your variable cost, a change in your volume, or a change in your fixed cost? That's what we mean by sensitivity. We want to know how sensitive is our profit to a change in selling price, a change in number of units sold, a change in fixed cost, and a change in our variable cost. Those are the most important things that you must learn, even those that will be used to assess, you will be assessed during the test. Then these are cases where CVP is applicable. Number 1, if we have to make a decision whether to make a product or to buy it. That means before you decide to outsource it, you'll have to compare your costs and those that your external supplier is willing to sell. Number 2, if you want to enter a new market, you make use of CVP analysis. Number 3, whether you want to close or to discontinue a product or a branch of your company, CVP analysis can still be used. Whether you accept or reject a once-off special order or offer, CVP analysis can also be used to influence your decision. So the assumptions are there in your book. Assumption number 1, it says to you, you must be able to know your variable cost. Number 2, you must be able to identify your fixed costs. Number 3, you are selling one unit or you know a combination of units you are selling. Those are some of the assumptions. Before you can make use of this CVP analysis in decision making, you look at the assumptions, and then you must know up to which or up to when. That's what we talk about a relevant range. So there are a number of techniques that you are going to learn, which we use to analyze our decisions or to make our decisions or to guide our decisions. Number 1, contribution margin. In our book, they will tell you that contribution margin is the difference between your sales and variable costs, which simply means contribution is sales price less all variable costs. The keyword is all variable cost. Sales price or selling price less all your variable cost gives you contribution margin. This is what we mean by variable costs. Our variable costs can be in the form of direct materials, direct labor, variable manufacturing overheads, variable sales, marketing, administration, and distribution costs, or even commission on sales. It's coming from the textbook on page 146, table 7.1. That is where you'll see them. Then this is how we calculate the three contributions. If we look at per unit, we'll say selling price per unit less all your variable cost per unit. Then you'll be calculating contribution margin per unit. Number 2, if you are calculating contribution margin revenue or in total figures, you will need your sales revenue less your total variable costs. If it's a percentage or a ratio, you can use either per unit figures or in total. If you are using per unit figures, it's going to be your selling price per unit less all your variable costs per unit multiplied by 100 divided by selling price per unit. Number 2, sales volume less variable costs multiplied by 100 divided by sales revenue also gives you contribution margin percentage or ratio. Break-even point. The definition of break-even point. Break-even point is a point where there is no profit or loss, or is a point where total costs equal total revenue. By total cost, we mean the sum of your fixed and your variable. Variable cost plus fixed cost give us total cost. Then you compare them with your revenue. If they are equal, then you know that your profit or loss will be equals to 0. Then you say you have reached a break-even point. The formula to calculate the break-even point units is total fixed cost divided by contribution margin per unit. By total fixed cost, we mean both from production and from our support department. Your fixed production plus your fixed administration plus your fixed any other cost that is fixed, we include it in this category of fixed cost before we can calculate the break-even point. Then in units, total fixed cost divided by contribution margin per unit. So in revenue, is your total fixed cost divided by contribution margin ratio or percentage. Then you will get it. Margin of safety is the third technique that we must know to determine how safe are we from break-even. That is the purpose of margin of safety. How safe are we from break-even? The excess amount above break-even, we call them margin of safety. For example, if your break-even is 2,000 units and your total is, or total to be manufactured or sold is 5,000, so the difference between this is 3,000. Then this 3,000 we call it margin of safety. Break-even point, we less it from estimated or actual production or actual sales. The difference we call it margin of safety. So margin of safety simply means budgeted or actual sales less break-even point. That is margin of safety in units. Then these are the formulas in units, in total, or percentage or ratio. Number one in units is budgeted or actual sales less break-even sales. Total margin of safety, actual or budgeted sales revenue less break-even revenue. Number three, percentage or ratio, we can use any of the two to get the ratio. Then determining the number of units to achieve a target profit. Then this is the formula. Total fixed cost plus target profit divided by contribution margin per unit. It will tell you the number of units that you must produce and achieve your target profit.